Hey guys, how's it going? Lewis Harding and this here, and welcome back to my channel. And in today's video, I'm going to be analysing Wise stock. I'll be using fundamental analysis to see if the company is worth buying or not. I'll be then using a DCF valuation to determine the fair value of their stock. Let's get straight into it. So who are Wise? So Wise PLC, formerly known as TransferWise, is a London-based fintech company founded by two Estonian businessmen in January 2011. So these guys deal with money transfers and they have basically democratised sending money overseas. Historically, it costs a lot of money to send money overseas and switch currencies. But TransferWise, or now known as Wise, were one of the pioneers in making these overseas transfers really affordable to the general public. The company IPO'd in 2021 and in one of the hottest IPOs in London, and I believe at the minute, I think the market cap is about £8 to £9 billion. So yeah, one of the biggest in a long time alongside Deliveroo. Now let's have a look at the sales summary for Wise, and yeah, it is split between personal and business. So personal in 2021 made up 81% of sales and business made up 19% of sales. Sales per region, so Europe in 2021 made up 32%, the UK made up 23%, Asia Pacific 21%, North America 17%, and then the rest of the world was 6%. Now let's have a look at the income statement for Wise PLC, and all of this data has come from Morningstar. So yeah, there's only 3 years worth of data because it's such a new company. You could go back into the previous accounts and have a look, but it's probably not worth your time. But as you can see, let's start with turnover. It's been increasing year on year, which is awesome to see. And then yeah, let's have a look at the profit. So this company's been profitable for a very long time, which for a relatively new company is very rare. Maybe because of the industry they're in, financial services, it's easy to become profitable quicker, but nevertheless it's a great achievement, with profit increasing year on year as well. So what the margins, under 10% still, but yeah, they're looking like they're improving the margins as well, which over time, that's what you want to see as the business matures. Now onto the balance sheet, and the first figure I like to look at is the long-term debt, or in this case, because it is like a UK based financial statement here, non-current debt. So non-current debt, long-term debt, same thing, just for words interchange. Let's have a look. So yeah, over time it's been increasing. It looks like as they have IPO'd or they're wanting to go to business, they've decided to increase the long-term debt to grow the business. So that's probably why they've done it. Still, you don't want to see it, but it is what it is. You can't do much about it. And then looking at the shareholders' funds, so shareholder equity, that's increasing as well alongside them being profitable. Now let's have a look at the cash flow statement for Wise PLC, and operating cash flow has been increasing year on year. Awesome stuff to see. Yeah, I don't have free cash flow on here, but I'm guessing over time that has been going up. Yeah, in fact, from the analysis, it has shown it has gone up year on year. So awesome stuff. Now let's have a look at the key financial ratios, and yeah, so for profit margins going up over time. Such a new business, young business, that you want to see these profit margins going a lot higher than they are, especially for a financial services company. Return on equity is looking decent now, especially for a new business, increasing year on year, which is awesome. Gross gearing, so this is all the debt in the business over what equity they've got, and this has been increasing, which is correlates to the long-term debt they issued. So gross gearing of 35% is not bad at all, let's be totally honest. If I'm looking at the quick ratio, it is above 1, so a lot of liquidity in the business. So yeah, some great stuff there. So let's have a look at the genuine impact stats, and we will start with quality. And yeah, number 22, very strong for the quality side of the business. So I'm not sure why the profitability isn't showing up, but we'll go with just what we've got. Financial strength, very strong. And then we're looking at capital allocation, very sound as well. But then we look at the value metrics, and it's looking a little bit expensive, to be fair, from the income statement and balance sheet perspective. But the cash flow statement's looking pretty cheap, so there's a little bit of a disconnect between them. Growth wise, as we've seen before, this is a high growth business, growing very rapidly, so there's no surprise that it's ranked well there. So some interesting insights there from Genuine Impact. Let's have a look at my analysis checklist now, and Wise PLC is listed in London, based in the UK. They've got a market cap of £8 billion, and the current share price as of recording was £8.32. They've got a PE ratio of 375, which is astronomical. And then let's have a look at some of the actual analysis that I do. So the gross profit margins are very, very strong. I had to go back into the year-end accounts to find out some of these, but from day dot they have produced very strong gross margins, likely to do with what business they're in, financial services. If you think of Visa and MasterCard, what margins they have, TransferWise, you would like to think in the future could get up to them kind of margins. Net profit margin isn't quite there, not surprisingly. If you take into account 0%, a few years of unprofitability, then it's going to bring that down. But I'm not worried at all about TransferWise's profitability. It's showing that it is a profitable business and it's going to increase it over time. As well as that, return on equity is hindered by having a few 0% in there. So I would not worry about that too much. Long-term debt to equity, also very manageable. You wouldn't want them issuing too much more debt. Hopefully they don't do that. Current ratio is above 1 as well, so a lot of liquidity in the business. Proven ability to grow, all greens across the board, with businesses growing revenue, net income and free cash flow, and then shareholder equity is going up as well. Great capital allocation. Well, my argument for this one would be that the business hasn't had enough time to show what capital allocation it can do yet. Long-term debt repayment, they issued some debt, so that's clearly a miss. Dividend growth, a company like this will not pay dividends. They're still growing as a business, so why would you waste your cash on paying out to shareholders when you can give them a better return by investing back into the business? Decreasing shares outstanding, I couldn't really find the data for this, so I'll just give it a red. It's likely that they've increased the shares over time, so it's probably prudent to put it as a red. Then good acquisitions, I haven't seen any acquisitions from TransferWise, so it had to be an X, unfortunately. But I'm sure over time this capital allocation will improve, and I'm sure as the business becomes more profitable, especially being a UK company, they will likely pay a dividend in the future. Who knows when, but I'll be very surprised if not. Buy it at a fair price for ultimate pillar. Unfortunately, it's looking a bit pricey based on price to earnings and price to free cash flow. The market is likely pricing in the next 10, 15, 20 years growth for TransferWise, but in my opinion, it's hard to know where the margins will end up for the business. It could end up like MasterCard and Visa, but they could end up a bit lower like PayPal, so who really knows. But for a 10% return, I'm looking at a share price of £1.10. It would have to drop 87% for me to be interested in this stock. You might think that's a bit drastic, but weirder things have happened in the stock market. Companies go to zero all the time, and in stock market crashes, weird things do happen. I believe in the 2000 tech bubble, Amazon went from something like $116 per share down to $4 per share. So if you work out what that is percentage-wise, it's a lot more than 87%. So weird things happen in the stock market. Valuations can get carried away. Anyway, let's have a look at my numbers and how I got to that 10% return. So let's have a look at the DCF valuation for Wise. And I've taken my free cash flow estimates from Analyst Estimates over a market screener. They have them all on there, so easy to see. They do update every now and then after earnings, so bear that in mind. Discount rate of 10%, I want a rate of 10% return. It spit out a share price of £1.10, so it will have to drop a bit for me to be interested. Maybe my DCF model's a bit prudent, only forecasting 3 years into the future. Maybe with this business you need to be doing 7 to 10 years, but I like to keep it consistent from the videos and keep it to 3. And the thing is, even if you increase your cash flow by a lot into the future, the share price would be still relatively low. So what are my thoughts on Wise PLC? So I believe the company is currently overvalued by quite a fair decent amount. No surprise really, because IPOs do often overprice stocks, and if you look at the history of IPOs, a lot of these companies do drop down in price over the next couple of years from IPO date. I know it wasn't technically an IPO, it was a direct listing for TransferWise, Wise, get them mixed up now, change of name and all that. But when companies list, they do often see a decrease in share price over the next couple of years, mainly because they get hyped up and it just comes crashing back down. and it settles about, you know, wherever it settles. But for this company, yeah, things are looking pretty good. If you look at all the growth metrics, we're all going up. Profitability, very profitable already for a new business, and the margins are increasing. So you want to see the margins go up over time, because if you get into the 20, 30, 40% mark, then that just shows how quality of a business Wise could be. And fingers crossed we do get there, because it would be really good to see some UK companies have some good margins like that. The only one to mind is Rightmove, who have some unbelievable margins really. But yeah, so I think where I stand with Wise is let the company mature a bit more, let their business model be proven, and let them show some good financials. Let the share price come down a little bit, let their financials, you know, show some consistency a little bit. And when that happens, there might be an opportunity to buy the stock, and then over time it might do really well. But yeah, who knows? A very interesting pick, and hopefully more companies like Wise list in the UK. If you enjoyed today's video, please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.